All right, Ashwini Agarwal joins us. Ashwini, in last 15 days, we've seen what could be called as an extreme, from extreme selling to a solid comeback. What is in store now? Do you think markets have normalized? Are happy days here?
Morning, Nikunj. Glad to be here. I think, the pessimism that was prevalent in early March has obviously faded away, and people are looking a little bit more optimistic. My personal feeling also is that, the correction has brought a lot of stocks down to reasonable levels compared to where they used to trade in the last quarter of calendar 24, for example. And therefore, a constructive outlook from a medium-term perspective is the right way to think about it. Having said this, I'd also like to point out that, obviously all of us are going to be watching what President Trump says tomorrow evening our time, and who it affects and how much it affects. But most importantly, I think I would like to highlight that a big reset is happening in the US economy, and that can lead to a loss of confidence in US dollar and US treasuries for global central banks as well as global economies. And that can have a lot of unintended consequences. So I would say that, while one should be constructive as a base case, there is a small probability, but a fairly scary outcome that we see upheavals that we haven't seen since the global financial crisis, or possibly the kind of uncertainties that surrounded us at the peak of COVID. So a reset of the US dollar, if that event were to pass, is not something that the world is pricing in. Everybody's talking about it. Everybody thinks that there is no alternative, so we'll muddle through it. And that is indeed my base case as well. But we should be aware of that risk.
Okay, so while we can, talk about dollar index at a macro level, I don't know whether it will happen or not. Well, investors have to look at stock prices, they have to look at businesses, they have to look at companies. So let's talk about that. Where are you picking your spots in this market? Where did you shop? What are you avoiding? And where do you regret that, oh, you should have bought it in the month of March?
Well, there are never any regrets in the market because the opportunities will always be there. So no regrets. But what we've done is added a few financials. I think as a sector, financials have significantly underperformed over the last 3 years. Several financials are very attractively priced, trading at around book or sometimes even below book. By and large, they're very well capitalized. By and large, the loan loss ratios are fairly limited. And growth outlook is reasonable. It's nothing exciting. Credit growth is 11%, but these companies can grow at whatever between 10 to 15%. And that's the kind of return that you should expect. A little bit of re-rating from, let's say, one-time price to book to 1.4 times price to book on average. And you can potentially look at a 20% return on a 3-year horizon. But again, these are names that one should be aware that if an extreme sell-off were to happen, they'll hurt the most because they have the highest leverage. So I'm going in with my eyes wide open, hoping that my base case plays out. So that's one area where I've invested. The other area is obviously some chemical companies, some pharmaceutical companies that I've liked for a long time. So there I've invested, and in one or two sort of smaller names which fell off too much, being very opportunistic. I think this is a market where bottom-up investing will pay. I don't think one can paint very broad sector-oriented landscapes. I think it's going to be a very bottom-up market where you see the risks adequately priced in and the stock has taken a beating. I think that's the place to invest.
So give me an example.
Sorry?
Give us an
I didn't
example.
hear you.
Give us an example where, just for our viewers to relate to it. You may own it, you may not own it, you may want to buy it, and again with the full disclosure, so that we can understand your thought process. The idea is not to perhaps convince you to give a money-making idea, but a thought which could be an original thought.
So, there are, for example, housing finance companies. You look beyond the obvious. Several housing finance companies are now trading at around book. Okay, I won't take a name because I'm conflicted, and it might be difficult to do that. But you can guess the names, and these are now trading at significantly lower valuations compared to their long-term median price to book multiples. If you get a housing finance company trading at 1.2 times price to book on a historical basis, delivering about 10% ROE with a leverage of just about 3 times and a good management in place, I mean, what is there to lose? So that is something that I'm looking at doing. Similarly, there are tech oriented financial lenders which have again fallen 50-60% from recent peaks. Valuations are not unreasonable, very strong balance sheets. That there again, one has taken a call to buy. That's one area that I'm quite excited about.
Interesting. Ashwini, how do you think the construct for the US equity markets to play out though? I mean, there as well, much like us, maybe last year, October, valuations are looking quite bloated. And then, of course, you know, how you have the entire uncertainty surrounding Trump. Having said that, some of those completely, marquee names like a Tesla, etc., have already had quite a fall actually from their 52-week peaks. Do you think the case is much higher for those equity markets to ease off purely basis, the uncertainties and the valuation concerns?
Aisha, I won't be comfortable commenting on individual stocks like Tesla, but the valuation dispersion in the US has been very high. So if you look at the FANG stocks or the Magnificent Seven, and you look at the rest of the market, they've been moving in different directions for the last 3-4 years. And while valuations appear cheap optically, I think what the market can deliver to you in terms of total returns, a significant component of that will come from what happens to the United States as a country and USD as a currency. I personally feel that there is just far too much uncertainty out there to say anything with a greater conviction. The US exceptionalism, which has driven the market for the last 10-15 years, is obviously being dismantled very deliberately. Now, unless Mr. President Trump sort of backtracks from whatever he's been talking about in face of a declining stock market and in face of higher interest rates, which are inevitable given the path he's going down, I would say that I would be cautious, notwithstanding the kind of correction that we've seen in the US markets.
Well, I didn't mean to ask you about Tesla in particular. Just wanted a view of the overall equity markets. So in this scenario then, Ashwini, I mean, where do markets like China, say, for instance, come into the fore? The tariff uncertainty, of course, and the susceptibility is much higher for that economy. Do you think this gush of inflows which moved into China and, because that sort of acted as disadvantage India as well, if you will, do you think that's going to get unshackled?
So my sense, Aisha, is that in the new world order, China will play a significant role. And there are a lot of Chinese companies which have the world-class technology, which have the lowest cost in the world. There is a problem of macro in China where there is aggregate debt is very high. But if you look at the corporate level, these are fantastic businesses trading at very low valuations. Also, what will happen is that the US, still being one of the largest savings pools in the world, as the dollar weakens, foreign assets will become more attractive to those pools of capital. And I expect that foreign equities or emerging market equities will do better than what they've done in the last decade or so, given how I look at a changing scenario ahead. And also, I think that as the world moves away from US dollar as a primary currency of trade, which is what the objective of the policymakers in the US seems to be, you will have a lot of bilateral trade, and China will play a significant role in that. Putting these together, I think the outlook for China as a market looks quite reasonable. Obviously, there are concerns and there are issues that we are all aware about. So we'll have to see how this unfolds. And closer home in the Indian context, what will also happen is that, while we may have bilateral treaties with the US that might protect us from the worst of the tariff punishment that is meted out to the rest of the world. We will also see, increasing competition from China in some of the areas that we work in. So I think it's going to be a mixed bag. One has to keep one's eyes open and look at opportunities on a bottom-up basis. But I think overall, I think that emerging markets will probably do a little bit better. I think India will be okay in a base case scenario. We might go through a little bit of a storm in the short run. If things turn out to be really nasty, I'm hoping there won't be a train wreck. That's how I'm thinking about it.
The dollar plays a big role here, and who knows which way it's going to head in the post-tariff regime. But other than that, Ashwini, I mean, do you sense that the major chunk of the pain for at least India is behind? The FII money is coming back now. We've already seen a rebound from those 52-week lows. Is the worst behind us?
That's my sense. My sense is that 22,000 on the Nifty, which is where the recent low was, will not get taken out. It'll probably get tested, maybe, who knows, but it won't get taken out. I also feel quite positively about some of the domestic-oriented businesses. I mean, whether it is in telecom or telecom infrastructure, or some of the consumer companies, which are largely Indian businesses catering to Indian consumers with not a significant sort of external business. I think all those businesses will do reasonably well. I mean, I think real GDP in India will also slow down in response to what's happening in the rest of the world via the exports, but probably at 5.5%. And with inflation in the ballpark of 4 to 5%, you'll have nominal GDP, which is 10% or thereabouts. And I think earnings of a similar nature will follow. So the larger companies in this context should deliver you returns of 10 to 12% per year. And if you're able to buy something which is trading well below median long-term historical valuations, you might be able to do a little bit better at about 15-18%. So if that's the return that you're looking for, I would tend to think that the worst is behind us. I'd again highlight that there is a small, probable, but possible risk that things go really awry because of the unintended consequences of the aggressive policies being pursued by the Trump administration. But we have to see how that unfolds. That's not a predictable event.
Well, unusual times. Let's see how it all unfolds. Good having you on the show, Ashwini. Thanks for your time.
Thank you. Thanks for having me.
Okay.
If you like this video, then like, share and subscribe to ET Now.